Hey traders, this is a very important tool called analyzing the dividend. Is it a healthy dividend? Is it a good dividend? Is it a sign that the company knows what they're doing? Wall Street.io has a great tool for this I want to show you because I came across a stock I was looking at that actually had a 10%, roughly 10% dividend payout. And I was like, wow, this is a cheap stock with a great dividend. This might be a great investment. But I'm going to show you how we use Wall Street.io. So in seconds, you can figure out if this company is going to have a sustainable dividend that's going to pay you out, if it's a good investment, and it's a sign of health. So I saw this company right here, for example, GNL. Don't know much about it, Global Net Lease. All we do is we go down to our fundamental tab. Watch how fast this is on analyzing the dividend. I'm going to go down to the fundamental tab. I'm going to give it a click. And under fundamentals, you're going to see we have overview, financials, earnings, all these things. Here's a valuation of the company right here. It's a decreasing valuation on price to sales. And the cash flow, the green line is what I'm looking at. So it shows it decreasing in value. That's great. But now what I'm going to do is I'm going to hide my face so you can see what I'm going to click here. This is financials. And what we've done is we put together a phenomenal image so you can see the dividend payout. So at first glance, you go, hey, 10.5%, excellent, right? Well, let's look deeper in this. It might be 10%, 10.5% right now. It's expected to pay out 228, but look at the history here. It spiked up to 178, and you can see it dropping down to 155. You can see these estimates, these actual payouts dropping. So it doesn't have a good, it's a high yield. That's excellent return for a dividend, for passive income. Now let's look at the financial health. Can they sustain this? So up here we have what's called the operating cash flow. The operating cash flow, of course, is the money that they have coming in that they have to pay their bills. Now looking at the dividend, are they going to be able to, is it going to be shareholder friendly? Can I count on the dividend? When you look at the 203 million, here's their capital expenditures of 25 million, which brings it down to 178. It's pretty simple math here. You subtract the expenses, that's their capital expenditures. And you can highlight this real quickly like this, and it'll tell you and learn anything with the tag, you can learn about it. And then you can see down here, here's the price of their dividends, 213 million. Well, guess what? That's more than what they have in free cash flow. The free cash flow is not enough to cover the dividends, which means they're over distributing. So you don't even have to read the numbers. It'll flag it right here if their budgeting is not making the cut. Also, the share buybacks are 162 million. So they're using up more than their free cash flow. And so it's at first glance, it's good, but this is not a good sign of, and it says right here, returning more free cash flow using debt or cash reserves. So as far as dividend, it is not something you could count on. It's a little rich in the price to ratios. So that's real quick way to look at it. I'm going to give you some examples here. Let's go to Verizon. Verizon's a well-known company, known for their dividends. Oh, hang on a sec. That is Visa, by the way, over distributing. Let me click on Verizon here. Shareholder friendly. That's all you need to know, because when you look at this, the software's already analyzed it for you. Again, real quickly, what do you have here? Operating cash flow minus their capital expenditures leaves 20 billion. They have 11 billion in dividend. That will cover it. It's shareholder friendly. They even have extra money after they do share buybacks. You subtract all that, they still have more free cash flow to put in the bank. And if you look at the trend here, 8%, which is really good. And you can see it's consistently grown every year. It's a 9 years reliable growth. And what we call that is, if you look at the 5-year compounded annual growth, it's 43.6%, which is excellent. High yield, grower, reliable, shareholder friendly. May hammer through a couple others so you can see an example here. AbbVie. Go to AbbVie. We have shareholder friendly, done. grower. Now it's a little spiky here in 2020 because that was, oh, hang on a second. That's Agilent Technologies. Let me go to AbbVie. Shareholder friendly, high yield, grower, reliable. Done. Exactly what you want to see. So again, shareholder friendly, high yield, 3.4%, grower, reliable. Done. And you can hammer through some of your favorite stocks. I'm going to go back to that Visa once more because I saw that caught my attention. Over distributing. So there's Visa over distributing, and I might want to wait. It is a grower, not as huge. It's a low dividend yield. It's reliable, but it's over distributing. So you want to find one that has a better budget. So you can see that and I'm going to compare Visa to Mastercard. We do Mastercard real quickly. Shareholder friendly. Big difference right there between two similar companies. Mastercard, they're both very low yield, which is surprising because they charge us like 27% on the credit cards, right? But they're kicking out a dividend yield very low, but at least it's reliable. Let me put in a couple here. So that it's really fun to kind of compare the different companies in here. VFC, looking at VFC, I was looking at this 2.17%. I forgot why I was looking at this stock, but I look at this. It's apparel manufacturers. They've cut their dividend the last 3 years, and it says right here declining. It's a solid 2.7. That's a solid. It's not great, not good. It's under inflation. It's strong here, but as you can see, it's volatile, and you can see the red and green here. It's just not flagged strong. Dividends, it's just, not really good. So you can see the graphics here. This tells you everything. Declining. You don't want that. So it's not about, is it a good dividend? It's about, is it sustainable? Here's Ford. Look at Ford. You can see it spikes up and down, 2.19%. And basically what I'm looking at here is there more money here than the actual dividends paid? Yes. And it's not, and right here you can see they lowered the estimate again. So it's kind of all over the place. 2.1 is solid. Let me look at another one here. I'm going to go to is popular company, Kraft Heinz. That's a really high dividend yield. That's really high dividend yield. But you notice they cut it here. They cut it here. It's not a grower. 18% grow over the last 5 years, but it's stuck at the same $1.60. It was higher many years ago. Shareholder friendly, but look at this. Watch. Free cash flow positive, but earnings conversion is weak. So there might be a better candidate. And it's a good dividend yield. It's just keep your eye on this because looking at these two numbers here, it's getting close. Earnings quality is low. So a lot of neat tools in here. One more I'm going to look at. Oh, Nike. Let's go look at Nike. Over distributing. There you go. Done. It's a good dividend. Not too bad, right? It's solid. It's been growing year over year. But what does it say? It says, watch out because the conversion is weak. They're actually over distributing. They have $1 billion in free cash flow, but they're paying out 2.4 in dividends. And they're buying back 30 million. So yes, they're hitting the mark, but don't be surprised if they have a bad quarter or two and they have to cut their dividend. Who's famous for this? A company called Intel. Intel, you can see declining dividend. And that was back in 2024. You can see CapEx heavy, free cash flow. So therefore you can't count on the dividend. And that would have been a great tool to have. This would have been a great tool to have if you're looking at the dividends on Intel back here in 2023 when it was declining. Why? Because if you look at the chart, when a company cuts their dividend, it looks nice now, but let's go back 5 years and show you what really happened. Here's where they cut their dividend from $50 in 2024 all the way down to 23. So that was more than a 50% drop off their high. So you can see that declining dividends when they start cutting them, could be detrimental to the stock price. And now having a tool like Wall Street IO gives you, you can check real quickly on any stock that you're going to invest in, especially for like covered calls. Check out the dividend for a sign of strength. One more. Let me just do one more. ABT. Good health company here, Abbott Laboratories. You can see on their shareholder friendly, done. You can see their growth, 9-year grower, reliable, shareholder friendly, done. They have plenty of free cash flow left, and you can drop down. They always have free cash flow. So they know how to budget their money. So there you go, guys. To check it out, that is how you use the dividend tool to analyze and read into good dividends or bad dividends on your stock in seconds using Wall Street IO. Coach Gino, Wall Street IO. Catch all of our training videos and learn how to use these great tools. See you there.